Imagine we are an independent power producer who has built a ground-mounted solar farm in Germany and is interested in adding a battery. Germany is a country with lots of ambition and support schemes when it comes to solar PV deployment. But what does the landscape look like when considering battery energy storage systems, or BESS? Research by Fraunhofer EASY indicates that Germany will require around 104 gigawatt-hours of battery storage by 2030. However, with a confusing regulatory context, Germany might struggle to meet these flexibility requirements. A recent study projects 57 gigawatt-hours or 15 gigawatt capacity of installed BESS by 2030, still a significant leap from today's numbers. Currently, when you connect battery storage to your existing EEG-supported solar farm to charge the battery with the generated solar energy as well as grid electricity, you lose your entitlement to the EEG surcharge. This makes revenue stacking through self-consumption and market trading challenging. The government is working on relieving these regulations to allow multi-use of batteries via its solar packages 1 and 2, but nothing concrete has been published yet. Today, we'll use GridCog to compare the financials of an EEG-supported solar farm versus a non-EEG-supported co-located solar plus battery project. I've created several scenarios with varying solar and BESS sizes, analysed over 20 years using wholesale and ancillary service market data from the past 12 months. Our first scenario will be a solar farm supported by EEG-floored wholesale prices. Our second scenario will be a solar farm exporting into the wholesale market without EEG support. The third scenario will take this and add a BESS, trading into wholesale and ancillary markets. Let's download our new investment case report to analyze these results. The data lets us make some interesting observations. For example, based on the last 12 months market data, a PV project larger than 7 megawatt peak generates positive cash flow by selling to the wholesale market, even without EEG support. When looking at the co-located PV plus battery project results, the data shows us that for a 7 megawatt peak solar farm, it becomes profitable to add a battery from a battery size of around 2 megawatt hours. A 3 megawatt hour battery co-located to the solar plant already generates a 3 times higher overall cash flow than a purely EEG supported 7 megawatt peak solar plant. And this, even though you would be losing out on any EEG support. These results are based on market data from the last 12 months, where only a small number of batteries were serving the grid, and revenue from wholesale and ancillary market services is expected to be a little lower in the upcoming years. Changes of the regulatory context will hopefully balance this out. Nonetheless, projects sometimes make more sense than you'd think. While regulations may not always be supportive, data sometimes reveals that their impact is less significant than expected. GridCog allows you to make well-informed assessments of your project's commercial potential, helping you avoid pitfalls and identify opportunities for your energy transition projects.